Look, I get it. You've been scrolling through social media and you see these people talking about dividend investing like it's the holy grail of passive income. They're showing you their portfolios, bragging about quarterly dividend checks arriving in their accounts, acting like they've cracked some secret code to building wealth while doing absolutely nothing. They're on YouTube, they're on TikTok, they're in Reddit forums, they're in Facebook groups dedicated to dividend stocks, and they're all selling the same basic idea. Buy dividend stocks, collect your checks, retire early, and live off the passive income. It sounds amazing. It sounds safe. It sounds like the responsible path to wealth that your parents would approve of. It sounds like something that doesn't require you to understand complicated markets or pick winners or time anything. You just buy stocks that pay you money. That's it. But here's what absolutely nobody tells you when they're promoting dividend investing as the fastest track to financial freedom. The whole thing is a carefully constructed myth designed to make you feel productive while you're actually moving slower than almost every other investment strategy that exists. It's like running on a treadmill while convinced you're racing forward. My name is Ian, and I help people understand that the financial industry doesn't care about what makes you rich. They care about what keeps you engaged, what keeps you feeling like you're winning, and what keeps you giving them fees. They care about repeat business. If you're someone who's been sold on dividend stocks as your path to wealth, or if you've ever wondered why dividend investors seem to brag so much while their actual net worth grows so slowly, hit that subscribe button and like this video. Because today we're going to expose the brutal truth about dividend investing that the financial industry desperately wants you to ignore. This is uncomfortable. This is going to make dividend investors defensive. But it needs to be said, the reason dividend investing feels so good is actually the exact reason it's so dangerous. When you own dividend stocks, something magical happens in your psychology. You get these little cash payments deposited into your account. You get quarterly statements showing your earnings. You can actually feel the money coming in. There's something deeply satisfying about that feeling. You've made progress. You've earned income. You're building wealth. It's tangible. It's real. It's why dividend investors are the most vocal, most excited investors you'll ever meet. They're not experiencing anything differently than someone who owns growth stocks, but it feels different. And that's the entire game. That feeling is the trap. It's not an advantage. It's a psychological illusion that makes you feel like you're winning when you're actually falling behind. Here's what happens. A dividend stock pays you 4% per year in dividend payments. Sounds great, right? 4% annual return without touching your principal. You're essentially collecting free money every quarter. But what you're not seeing, what you're completely blind to because you're distracted by the dopamine hit of receiving a payment, is what that same capital could have been doing in a non-dividend paying stock. Maybe that company is choosing to reinvest its profits into research, into expansion, into buying back its own shares at discounted prices, into developing new products that will dominate markets. While you're collecting your 4% dividend, that growth stock is compounding at 7, 8, sometimes 10% per year. You're happy getting your checks. You show your dividend statement to your friends. You brag about your passive income stream. The other investor is building twice the wealth with the exact same starting capital. And nobody even knows they're doing it. The dividend investor feels like they're winning because they have money in their hand. The growth investor is actually winning because their net worth is exploding. This is the hidden game nobody wants to talk about because the financial industry makes more money when people feel satisfied than when they're actually getting rich. A satisfied dividend investor is a sticky customer. They keep their money in the same accounts. They keep paying fees. They don't question the strategy. Let me show you the actual math because this is where dividend investing absolutely collapses under scrutiny. Say you've got $50,000. You could buy a dividend stock that yields 5%, meaning you'd collect $2,500 per year in dividend payments. That feels amazing. 2,500 bucks appearing in your account every year. I get it, free money. But if you take that money and reinvest it, which most people don't do consistently because they're actually trying to live on the dividends, you're now buying more shares. You're essentially compounding. But here's the problem that nobody mentions. And I mean absolutely nobody in the dividend community wants to talk about this. The dividend payment is taxed. Depending on how the dividend is classified, you're going to pay somewhere between 20 and 40% in taxes on that money before you ever get to reinvest it. If you're in a high income bracket, it's closer to 40%. So that $2,500 dividend payment becomes maybe $1,500 to $1,800 after taxes. The government just took $900 to $1,000 of your dividend. You're not reinvesting the full dividend. You're reinvesting the remainder. You've lost a massive chunk before you even get the money back into the market. You've got less capital working for you. Now multiply that over 30 years. Year after year, dividend after dividend, taxes eating away at your compounding. Now compare that to a growth stock paying no dividend. That same capital is appreciating, and you're not paying taxes on anything until you decide to sell. You're not bleeding capital every single year to the IRS. Your entire position is compounding without constant taxation, eating away at your returns every quarter. By year 10, the difference is absolutely massive. The dividend investor has paid tens of thousands in cumulative taxes. The growth investor has paid zero. Nothing, not a dime to taxation. The dividend investor's after-tax returns are getting crushed by a factor that most people never calculate. But they don't feel like they are because they've got the psychological satisfaction of seeing dividend payments. That's the sleight of hand. The feeling is better than the math. This is where it gets really uncomfortable for dividend advocates. When you look at the actual historical returns of high dividend stocks versus growth stocks, the data is absolutely clear. High dividend paying stocks have underperformed the overall market for the past decade. Not slightly, not even close. We're talking about significantly underperforming. The stocks that pay the highest dividends are often mature, slow growth companies that aren't expanding, aren't innovating, and aren't capturing market share. They're paying out dividends because they don't have better uses for their cash. They're stuck. They've peaked. They're essentially saying, we've run out of ideas, so here's your money back. Here's capital we don't know what to do with. Meanwhile, companies like Microsoft, Apple, Amazon, Nvidia, Tesla, and the rest of the actual growth engines of the economy are reinvesting every penny back into their business. They're buying back shares. They're expanding into new markets. They're developing artificial intelligence. They're researching next-generation products. They're taking risks. And guess what? Their stock prices have gone up dramatically over the past decade, while dividend stocks have stagnated. We're not talking about marginal differences here. An investor who bought Microsoft 10 years ago and just held has made roughly 500%. Someone who bought a utility stock paying a 7% dividend has maybe made 50%. That's a tenfold difference in returns. 10 times. And that's before taxes. After taxes, it's even more dramatic. This isn't luck. This isn't a fluke. It's the actual nature of how wealth compounds. There are exceptions, but for most investors, most of the time, this is how the math plays out. Companies that focus on growth create more shareholder value than companies that focus on distributions. But the dividend narrative is so seductive that people ignore this data completely. They rationalize it away. They tell themselves that growth can't continue forever. They convince themselves that their dividend stocks are just out of favor and will come roaring back. They don't come roaring back. The whole thesis is flawed. Here's another truth that absolutely nobody wants to talk about, and this is where dividend investing becomes truly dangerous. Dividends aren't guaranteed. Companies cut dividends all the time. When the economy slows down, when a company runs into trouble, when management changes, dividends get slashed. Real estate investment trusts, which are heavily promoted as dividend powerhouses, have cut dividends dramatically multiple times in the past 20 years. Utility stocks, the supposedly safe dividend aristocrats, have frozen dividends during downturns. The moment a recession hits, the moment interest rates go up, the moment a company's earnings miss expectations, dividend investors find out their supposed passive income isn't so passive. They're not getting their check. The stock price often drops at the same time because people panic and sell. You're now taking a double hit. Your principal is down and your expected passive income is gone. This is the sequence risk that dividend investors ignore. If you're in or approaching retirement and you're Relying on dividend income to cover your living expenses, an economic downturn that cuts dividends right when you need the money, is absolutely catastrophic. You're forced to sell stocks at the worst possible time to cover your expenses. You're locking in losses, you're spiraling down. Growth investors don't face this problem the same way because they're not dependent on dividend payments. They adjust their withdrawal strategy based on overall portfolio value, not on expected cash flows from a single income source that's completely unreliable. What dividend advocates never want to admit is that dividends are actually just a return of your own capital in a different form. When a company pays a dividend, that money comes from the company's cash reserves. It's not new money. It's not free money. It's literally cash that belonged to the company that the company is now giving back to you. The moment that money leaves the company is worth less. That's why dividend stocks almost always see their share price drop by approximately the amount of the dividend on the ex-dividend date. You're not getting ahead. You're getting your own money back. The only thing that's happening is you're being taxed on it. You're creating a transaction. You're creating paperwork. You're creating tax liability. And then you're supposedly getting ahead, which is absolutely ridiculous when you think about it clearly. A company that doesn't pay dividends but instead buys back its own shares is doing the exact same capital return to shareholders, but in a much more tax-efficient way. The share price goes up slightly. You don't get taxed until you sell. You have full control over when that taxation happens. You can defer it indefinitely, but nobody gets excited about share buybacks because there's no emotional satisfaction. There's no dividend check appearing in your account. There's no feeling of passive income. So instead, the entire financial industry keeps promoting dividends, even though buybacks are mathematically superior from a wealth-building perspective. Let's talk about inflation because this is something dividend investors almost never discuss. Your dividend stocks might be paying you 5% per year, which feels amazing, but inflation is 3 to 4% per year. Your real return after inflation is somewhere around 1 to 2%. You're barely keeping pace with inflation. Meanwhile, growth stocks that are compounding at 8 to 10% per year are delivering 5 to 7% real returns after inflation. You're not just slower than growth investors. You're almost entirely flat in real purchasing power. You're collecting money that looks impressive on a statement but doesn't actually make you meaningfully richer in inflation-adjusted terms. This is the sleight of hand. The financial industry shows you the nominal returns. 5% dividend yield sounds great, but nobody's talking about the fact that your purchasing power is barely moving. Over 30 years, inflation compounds too. That 5% nominal return becomes almost nothing in real terms. Dividend investors are being paid to stay still, while inflation slowly erodes their wealth. Growth investors are actually getting ahead of inflation and compounding real wealth. Here's the thing that absolutely nobody in the dividend investing community wants to address head-on. Dividend stocks are often more volatile than you think. They're not the stable, boring investment that the marketing suggests. Dividend stocks are still subject to market cycles. They still go down in recessions. They still get hit when interest rates go up. In fact, when interest rates go up, dividend stocks often get hit harder than growth stocks because the dividend yield becomes less attractive relative to bonds. All of a sudden, your dividend yield of 5% doesn't look so good. When bonds are paying 5% risk-free, investors start selling dividend stocks. The stock price crashes, your yield stays the same on a much lower stock price, which sounds good, until you realize you just lost 20 or 30% of your principal to get there. Dividend investors are telling themselves they own something stable while holding something that's just as cyclical as everything else. Except it's compounding slower. That's not a good trade-off. That's a bad trade-off with better marketing. Let me address the most common counter-argument because I know what dividend investors are thinking right now. They're thinking, but Ian, I need the income. I'm retired. I need cash flow to cover my expenses. Growth stocks don't pay anything. How am I supposed to live off my portfolio if it doesn't generate income? And this is where understanding the actual math of portfolio withdrawal is critical. You don't need dividends to create cash flow. You can sell shares. If you've got $1 million portfolio and you need to spend $50,000 per year, you don't need to own dividend stocks that pay you $50,000. You can just sell $50,000 worth of shares and you've created your own dividend. Except you're doing it in the most tax-efficient way possible. You get to choose which lots to sell. You get to harvest losses. You get to control your tax liability. You don't have to take distributions you didn't plan for because a company decided to pay a special dividend. You're in complete control. But the dividend narrative is so seductive that people think they need to own dividend stocks to create income, even though mathematically they're creating worse outcomes than if they just held a diversified growth portfolio and sold shares as needed. There's also this weird assumption in the dividend investing community that you should reinvest all your dividends, which basically admits that dividends alone aren't creating the returns you want. If you're reinvesting the dividend, you're not actually living off dividend income. You're compounding your position. You're essentially doing the exact same thing a growth investor does, except you're doing it less efficiently because you're paying taxes on the dividends before you reinvest them. Dividend reinvestment sounds good on paper. In practice, it's undermining the entire thesis of dividend investing. You've basically admitted that you need growth to get ahead. You can't actually live off the dividends. You need the compounding. But you chose a strategy that taxes that compounding heavily and delivers it more slowly than alternatives. That's not a plan. That's a rationalization for making a poor choice and not wanting to admit it. Look, the real reason dividend investing is promoted so heavily is because it's emotionally satisfying. It checks boxes that people want checked. It feels passive. It feels like free money. It feels legitimate and boring enough that your parents would approve. It feels like you're not being reckless or speculative. It feels responsible. The financial industry knows this. They know that people will stick with a strategy that feels good even if it objectively performs worse than alternatives. They know that a person collecting dividend checks feels engaged with their investments in a way that someone buying and holding a growth portfolio doesn't. That engagement means they're more likely to stay the course. They're more likely to keep giving the financial industry fees. They're more likely to feel satisfied enough not to ask questions about whether they could be doing better. It's the perfect marketing machine. Give people an emotionally satisfying strategy that happens to be worse than the alternative, and they'll promote it themselves. They'll convince their friends. They'll write about it online. You don't even need to advertise. The satisfied dividend investor does all the marketing for you. So what should you actually be doing if you want to build real wealth instead of collecting quarterly checks that make you feel like you're building wealth? The answer is almost boring in its simplicity, and that's exactly why people don't do it. You build a diversified portfolio of growth stocks, whether that's through index funds, target date funds, or individual stock selection if you have conviction. You invest consistently. You reinvest everything without paying taxes on the reinvestment by holding it in tax-advantaged accounts whenever possible. You don't touch it for decades. You let compound interest actually compound without taxation, eating away at your returns every year. When you need income, whether that's in retirement or any time else, you sell shares in the most tax-efficient way possible. You have complete control over your cash flow. You're not dependent on whether some company decided their dividend was safe this quarter. You're not dependent on whether interest rates went up and made your dividend yield less attractive. You're building actual wealth, not collecting the illusion of wealth. Over 30 years, the difference between this approach and dividend investing is absolutely enormous. We're not talking about marginal differences here. We're talking about someone who owns dividend stocks potentially having 50 to 100% more wealth if they just switched to a growth-focused strategy and reinvested everything without the constant tax drag. That's not a slight difference. That's generational wealth. That's the difference between retiring at 60 and retiring at 75. That's the difference between leaving your kids an inheritance and dying with barely enough to cover your funeral. The dividend story is seductive because it makes investing feel like something is happening. It makes you feel like you've solved the puzzle. You own dividend stocks. You're getting paid. You're winning. But the actual winners in investing are the people who understand that wealth compounds faster when it's not constantly being interrupted by distributions and taxation. The actual winners are the people who can delay gratification. The actual winners are the people who can own a portfolio that doesn't make them feel good in the moment because it's designed to make them rich over time. If you want passive income in retirement, you can have it. You can have it more tax efficiently and more sustainably by owning a diversified growth portfolio and withdrawing from it systematically than by chasing dividend yields. If you want to feel like something is happening to your money while you build wealth, you've been sold a narrative that's working against you. The financial industry is perfectly happy to let you chase dividends forever because it means you're not asking the harder questions. It means you're not optimizing your strategy. It means you're satisfied enough to pay fees and stay the course, which benefits everyone but you. Don't be that person. Run the actual math. Compare your dividend portfolio returns to a diversified growth portfolio over the past decade. Look at after-tax returns. Look at total wealth accumulated, not just cash flow. Once you see the numbers, you'll understand why dividend investing is the most marketed strategy for investors who want to feel good without actually optimizing for wealth creation. The truth is uncomfortable for the dividend community because it contradicts the narrative they've built their entire investment approach on. But the truth is the truth. Dividends feel like passive income. Growth is actually passive income. It's just less exciting to talk about. If this helped clarify what real progress looks like in dividend investing, subscribe and like this video. If you want to understand how to tell if your dividends are actually growing, I broke that down in the video on your screen. I'll see you in the next one.